Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I hope you all had a relaxing weekend. After 2 months of devastating lockdowns, this week may be the week that large parts, though not all, of Shanghai finally begin opening up and return to normalcy. In a special press conference yesterday, Sunday, Shanghai authorities announced that the city will cancel many conditions for businesses to resume work from Wednesday and will also introduce policies to support its crisis-hit economy. Of course, we have examined the extent of the damage in recent weeks, with manufacturing, retail sales, property activity, logistics, and other economic indicators all devastated. Indeed, over the weekend, local Shanghai media published a survey of small and micro businesses, and the findings were quite concerning. As of last week, 54% of small businesses surveyed are not operational, with only 1 in 5 fully or mostly operational. Only 16% said that they had been able to operate normally during the lockdown, and just 6% said that during the lockdown period, supply chains had not been affected. Fortunately, the majority of businesses surveyed do not plan to reduce their operations after the lockdown ends. Now, assuming that the survey is accurate, it's still hard to know to what degree a survivorship bias exists. But one thing is for sure, Shanghai's economy has been hit hard and will need a lot of support. Local officials announced an action plan of 50 policy measures at the press conference yesterday, including the use of local government bonds, loans for small and medium-sized enterprises, and accelerating real estate projects to boost the economy. The quota for car ownership this year will be increased by 40,000 in the city, a purchase tax for some passenger vehicles will be reduced, and subsidies will be given to electric car buyers. The Deputy Secretary General of Shanghai expressed that the measures are expected to provide 300 billion yuan or $45 billion of support, though this pales in comparison to the cost of the lockdown for the financial megacity. The markets appear to be quite happy with the news, with stocks in Asia and US futures advancing on Monday. Restrictions on movement are also set to be loosened this week. Shanghai will ease COVID test requirements for people who enter public places from the 1st of June. So these are the promises. We will find out over the next week or so whether they will be followed through with. And of course, the elephant in the room is the risk of a rebound in cases, which could push nervous, trigger-happy authorities to plunge the city back into lockdown. Now, while we're here, the capital city, Beijing, has also eased movement restrictions in several districts after local authorities announced that the outbreak was under control. New official cases on Sunday saw their 7th straight day of decline, but we will have to keep our eye on this and several other cities over the next few days. Okay, so that is the Shanghai economy. Now let's move from the Yangtze River Delta to the national economy. If you guys are enjoying the video, don't forget to hit the like button, and for anyone who wants to go the extra mile and help keep this channel sustainable, Patreon, Buy Me a Coffee, and Bitcoin links are in the description below. Thank you everybody for the ongoing support. Okay, the Chinese economy. We are now seeing a national rollout of subsidies to airlines and consumables as Beijing begins to implement the massive stimulus measures announced in the previous weeks as the economic outlook becomes increasingly poor. We remember that last week, UBS Group AG cut its 2022 China GDP growth forecast to just 3% from 4.2%, with JP Morgan Chase & Co. doing the same, cutting its forecast to 3.7% from 4.3%, all well below the 5.5% target set by Beijing for this year, though even Premier Li Keqiang admitted last week that 5.5% is unrealistic. Late last week, the Ministry of Finance and Civil Aviation Administration of China jointly issued a statement expressing that airlines will receive compensation of as much as 24,000 yuan, about $3,500 per flying hour in weeks where they lose money and the average passenger flight is less than 75% capacity. We already discussed Shanghai earlier in the video, but several other major urban centers have also in recent days rolled out subsidies to boost consumer spending. We remember that in April, retail sales, a good proxy for consumption, nationwide plunged 11.1% year on year. The southern metropolis of Shenzhen, to give one example, issued a series of measures to subsidize purchases of new energy vehicles, electronics, home appliances, and tourism. For example, residents there will receive a subsidy equal to a 15% discount on their purchases of certain electronics, such as smartphones, laptops, and televisions. Now, moving from the economy generally to the housing market specifically. Well before the Shanghai lockdown, China was wrestling with a housing crisis, which by itself was a serious threat to the national economy. Though the lockdown served as a strong distraction, this crisis remains, and most analysts agree that China's housing market will likely worsen this year, with prices remaining flat and sales and investment falling further. Since the beginning of the year, the number of cities which have taken steps to boost property buying, from mortgage rate cuts, smaller down payment requirements and subsidies, is now over 100 cities. But all of this has had little effect, and the outlook remains dim. For example, according to a Reuters survey of 13 analysts and economists conducted between May 16 and May 23rd, average home prices are estimated to fall 1.3% for the first half of this year. Now, considering cadres have been instructed to not let property prices fall, this is a big deal. The Reuters poll sees property sales slumping 25% in the first half of 2022, with a 10% decline for the full year. Investment by real estate firms is expected to fall 5% in the first half of the year and drop 2.5% for the whole year. Now, this brings us back to our old friend, China Evergrande Group. Hong Kong and Western media is reporting that Evergrande is considering repaying offshore public bondholders owed around $19 billion with cash installments and equity in two of its Hong Kong listed units. Of course, Evergrande is already deemed to be in default after missing payment obligations late last year. The South China Morning Post reports that the plan is to pay offshore creditors the principal and interest that they are owed by turning them into new bonds to be repaid over a period of 7 to 10 years. Now, it is difficult to know what sort of sign this is for investors, but the devil will ultimately be in the details. And of course, Evergrande still has a debt in the hundreds of billions of dollars. Indeed, most of Evergrande dollar bonds have fallen below 10 cents on the dollar. Evergrande aims to finalize this plan by July, according to sources that have spoken to both Hong Kong and Western media. While state intervention has quelled market concern over a disorderly collapse of Evergrande, investor confidence in what was considered a too-big-to-fail industry has been deeply shaken due to the ongoing crisis. More crisis-hit developers are also begging for time. Chinese financial media outlet Caixin reports that, to ease the real estate industry's financing troubles, regulators have, quote, persuaded some institutional investors to go easy on developers, asking for more time to repay their debts, as a measure to prevent more defaults. End quote. Several big developers, including China Evergrande Group and Sunic China Holdings Limited, have received approval from domestic creditors to extend their repayment periods. Okay, that is today's macroeconomic focused episode of China Update. Thank you so much, everybody. I'll see you tomorrow.